Hello everyone, welcome. Thank you for joining us for today's webinar where we'll be talking about financial and prudential regulation. My name is Janet Anderson. I am the Aged Care Quality and Safety Commissioner. I'd like to start by acknowledging the traditional owners of the lands on which we're meeting today right the way around Australia and pay my respects to elders past and present, and indeed extending those respects to any Aboriginal and Torres Strait Islander people who are joining us for today's webinar. A few housekeeping matters first. We will be recording this session and you will be able to access it again or recommend it to your friends or colleagues by finding it on our website later this week. Please join in the conversation by submitting your questions to us using the appropriate button. We'll be happy to take as many of those questions after the panelists have finished their sessions, and any we don't get to, we will ensure are dealt with also on our website. And finally, there is a survey at the end of this webinar. We would like to ask you to stay on to complete the survey. It won't take terribly long, and we do look closely at the feedback to understand whether we've met your needs and whether you have any particular recommendations or suggestions to make about topics for us to cover or different approaches we might take to convey what we consider to be really important and hopefully useful information. So, as I said, today's webinar is all about financial and prudential regulation, and I'd like to introduce today's panel members who will be talking about different aspects of this. The panel is led by Peter Edwards, who is Executive Director of Compliance Management, I beg your pardon. He's joined by Paul Heinemann, Senior Director of Financial and Prudential Regulation, Rochelle Stanwicks, Director, Provider Engagement and Monitoring, and Laura Todorowski, Acting Director, Assessment, Investigation and Compliance. So without further ado, I'll hand you over to Peter, who will provide some introductory comments and lead you into this subject. Thank you, Peter.
Thanks very much, Janet, and really good to be with you all. I think there are about 1,700 people who registered. I don't know how that's translated to people attending, but I'm always heartened to see that there are folk who are willing to set aside time out of their busy schedules to come and hear it as people talk about financial and prudential regulation. I know that for some people it's probably not the top of their list of most exciting topics, but good money management matters, and certainly it's a very important contributor to sustainable delivery of quality care in the aged care sector. And that's why, as a commission, we decided to set aside time specifically to do a webinar on the topic. As Janet mentioned, I have some staff with me today who work with both residential and home care service providers in this space. We do hope that we can sort of scoot through the presentation in reasonable time to make sure that we have time to take your questions at the end, and so I do encourage you to put the questions in the chat, and so that we can work through them in the time we have at the end of the presentation. I'll start with a bit of history about the function and its importance to us understanding both provider and service level risk. The first thing that's worth noting is that for many older Australians going into residential aged care, they hand over a large amount of money to providers as what is called a refundable accommodation deposit, or RAD for short. Now, when they do that trusting it will be returned to them or their families when they leave the service or sadly pass away. In recognition that this money represents a substantial part of older Australians' remaining wealth, the Commonwealth Government guarantees those deposits will be refunded in the event a provider ends up insolvent. Currently, the Commonwealth's overall liability exposure in relation to the scheme is around $35 billion. And that's a big number, particularly when you consider that 1% of 35 billion is $350 million. So it's for that reason it's essential that providers maintain proper financial controls to manage the risks of holding those deposits. And the prudential standards are designed to assist providers with that task by putting in place some useful guide rails for them to follow. Although the original objectives of setting prudential standards were the protection of RADs, there's a growing appreciation of the relationship between good financial governance and service capacity to maintain delivery of quality of care. And that's one of the reasons the Commission took over responsibility from the Department of Health and Aged Care for provider level financial viability monitoring on 1 July of this year. This function now gives us, as a Commission, a much wider array of information and data to understand provider level risk, which helps inform the regulatory approach that we take. As you'd be aware if you've attended previous webinars, our ultimate goal as a Commission is to see providers actively working to make the changes they need to make to continuously improve and manage risks to consumers. So a well-rounded understanding of financial issues can assist in building regulatory strategies that take into account the full range of barriers a provider might face in working towards achieving that goal. You know, such in this case, such as poor financial forecasting skills, because that capability is important when it comes to planning investment in things that might be needed to support their continuous improvement journey. So taking a holistic approach to provider risk aligns with the findings of and recommendations of the Royal Commission, which recognise the importance of having suitable measures in place to understand financial risk in order to build financial and operational resilience of the sector over time. One important metric the Royal Commission considered was provider liquidity. That's something that residential aged care providers already need to manage if they hold RADs by having a liquidity management strategy. My colleague Laura will talk further about what that means and why we're currently considering ways to further strengthen the standard to help providers manage that task. My colleague Rochelle will also discuss how we approach the task of understanding provider financial risk and the different ways and types of interventions we use to help providers build financial controls and capabilities in order to prevent a financial crisis that has the potential to impact quality and safety, but also importantly, accessibility of care. But for now, I'm going to hand over to Paul, the Senior Director of the Financial and Prudential section, who will talk further about the function. Thank you, Paul. Over to you.
Thank you, Peter. Firstly, I'd just like to reiterate Janet and Peter's words and thank you all for joining us today. I'm actually really excited to provide you with an insight into the way in which we work. Before I go into that, I'd just like to add to something that Peter just mentioned, which has also been reinforced by the recent Aged Care Quality and Safety Capability Review. Now, what that is the growing recognition that as a regulator, we cannot separate financial matters from safety and quality risks. Now, I'll start by disclosing I am an accountant by background, and people do often assume that accountants are only interested in counting money. And to be honest, it's partially true. But like most accountants, I'm actually more interested in where the money goes and how it is used. And this is really because money is the medium through which we express what we value. And when I look at what a person or an organisation is spending their money on, it tells me a lot about the things they care about. And it is for that reason that there is a legitimate public interest in how aged care providers spend their money, as the community rightly expects that the money will flow towards activities that are delivering sustainable, high quality, safe and secure aged care services. Now, at the Commission, we understand that the management of residential and home care aged services is a very complex business. There are lots of inputs that all must come together and be delivered at the right time and in the right way to create the services that older people need. And each of these inputs come at a cost. Now, if that complexity is not properly managed and supported by appropriate governance oversight, it places the interests of older Australians receiving care at risk. Now, it's for this reason that the prudential standards exist. These standards promote the effective financial management and governance oversight by providers of aged care services. Now, I also need to acknowledge that there will always be debates about the adequacy of funding. Now, this is certainly happening now, which is why the government is exploring options through the Aged Care Task Force, which will help it make decisions about how to best fund the system in the years ahead. Now, however, what we at the Commission are focused on is ensuring aged care providers have in place strong financial management and effective governance oversight controls. These controls are essential in maximising how the money providers receive is effectively used for the benefit of consumers, while also ensuring that they maintain sufficient reserves to manage any short-term cash flow issues that could ultimately challenge their solvency and ability to provide appropriate quality care. What we know is that where these controls are lacking, it can lead to expenditure decisions that harm consumers, such as cutting corners on care or using refundable accommodation deposits for non-permitted uses. Given the aged care sector is made up of a diverse range of providers, it is these foundational financial capabilities that the Commission is focused on developing across the sector through the work in which we do. This is a crucial ingredient alongside any funding decisions made by government to build a sector that can deliver sustainable, high-quality care. Excuse me. Now, as recommended by the Royal Commission, we have been investing heavily in bringing into the Commission a broad range of expertise to support these outcomes. This expertise enables us to monitor and analyse financial data alongside all the other information which we hold in relation to provider performance. This will enable us to identify the providers whom we should actively engage with, and that's those that are displaying emerging financial risk that has the potential to impact care or the capacity to repay refundable accommodation deposits on time, every time. Now, I'll explain how we work to achieve that through reference to our regulatory diamond, as that highlights the importance of one of the key things that we are striving to do. One of our key priorities in is to build sector awareness through providing accessible and fit-for-purpose guidance materials and educational products that assist providers to move towards the top of the diamond and to best practice. Over the last 12 months, we have invested heavily in raising sector awareness of prudential obligations and also the broader business benefits that they enable. In developing those materials, we have drawn on our understanding of the barriers to compliance through the range of activities we perform. And key is the intelligence we gain through our work, meeting and talking with providers across the sector. We will continue to deliver new educational products and guidance materials each year. My colleague Rochelle will talk about the different ways in which her team engages with providers shortly. And underpinning Rochelle's work is our ongoing analysis of the financial data and annual prudential declarations which are submitted by providers through the quarterly and annual returns. We use this information, as I previously mentioned, alongside a range of other intelligence sources to help us detect providers that are displaying early signs of financial risk. And depending on the nature of that risk, we will develop a suitable regulatory strategy and my colleague Laura will talk in more detail about how her team approaches that work. Now, before I hand over to Laura, I want to leave you today understanding that our central focus is on building sector capability, whilst ensuring that there are suitable incentives in place to deter providers from acting in a manner that is contrary to the interests of older Australians in their care. Now, in short, where we find that a provider is failing to comply with their prudential obligations, our desire is to work with them to address the cause of that non-compliance, only drawing on our regulatory powers where we find resistance to do what is required or intentional misbehaviour that has harmed the interest of consumers, particularly where that involves misuse of refundable accommodation deposits. Now, I have the pleasure now of handing over to Laura, who will talk about her role leading our analysis and prudential compliance management function.
Thanks, Paul. It's great to be with you all today. So today I have this excellent opportunity to discuss some of the work we do, particularly as it has changed a little bit over the last couple of years, and most importantly, since 1 July this year, where we have taken over responsibility for provider-level financial viability monitoring, which is something that we've been gearing up to take on for a little while now. So to set the scene a little bit, my team has carriage of both the routine assessment and analysis of a provider's financial and prudential position, and we do this at regular intervals throughout the year. And we also have responsibility for escalated compliance activity. So for today, I'll focus mostly on the assessment and analysis side of things and the way that it dovetails with other areas in both the Commission, but the Department of Health and Aged Care as well. I'll try my best to make the session as practical as possible, and do forgive me because some of the content is a little bit dry. But to kick us off, I guess I'll start by describing some of the different types of information we receive, what prompts us to potentially look more closely at a provider's financial situation, and then how we go from there. So those of you that are listening today with us who are providers, obviously you will know that throughout the course of your year, you're required to submit financial and prudential data to the department. Now, typically this is by lodging either your quarterly financial reports and an annual return, which contains details of your audited accounts, along with a prudential declaration if you're a resi provider. And for most providers, this occurs by the 31st of October. So what happens is all of this information gets given to the department when you lodge and then is shared with the Commission. Actually, on that, I should mention there's an excellent resource available on the Commission's website that displays the various report types and due dates, and it's in a calendar format, which is really useful. So if you haven't seen it, or if you're ever wondering kind of where you're up to with your reporting cycle, that's a great resource and you should check that out. So the information that providers submit obviously is very important in assisting both the department and the Commission's understanding of how providers and the sector as a whole is performing. The requirement to regularly provide financial information was something that the Royal Commission considered to be very important, both in market management and planning, as well as the regulation of the sector. Some of you may have seen that the department uses this information to report on how the sector as a whole is tracking, and they do this through the quarterly financial snapshot of the aged care sector. We draw on the same data, but our focus is at the provider level rather than the sector level. And actually that's probably a good segue to also note that the assessments that we do are also at the provider level, not the service level, as other areas of the Commission take in kind of a service level view. We take it at that provider level view. So we take in the data along with a wide array of other information that we hold regarding a provider's performance to then assess financial viability and prudential risks of individual providers. There are several reasons that might lead us to undertake analysis, and depending on what prompted it in the first place and what was found, we then determine the best approach. So one of the first reasons can be when another part of the Commission is working with a provider in relation to quality and safety issues. So in these cases, there's often a real benefit in having a picture of the financial or prudential risk that may influence the provider's capacity to take the necessary remedial action. So we work closely with other parts of the Commission in those higher risk matters, as this enables us to better understand the impact of different regulatory strategies. One of the other ways that we might be prompted to examine a provider's affairs is based on concerns that our own internal risk detection tool might flag. So this tool incorporates the information submitted as part of the required reporting that we mentioned earlier, and then draws on a range of different indicators to rate a provider's relative risk compared to other providers. So this gives us some visibility of providers that may be showing early signs of financial viability problems, for example, or may have had a real change in their business year to year. And this may lead us to refer a provider to the provider engagement and monitoring section, which is Rochelle's area, and I'll pass you on to her in a moment. And they will then begin a conversation with those providers about their financial situation to address these risks. Lastly, we also analyse and investigate financial arrangements that suggest a provider may be placing refundable accommodation deposits at risk through a lack of compliance with the prudential standards. Those standards require providers to comply with obligations in relation to governance, reporting, liquidity, and disclosure. And finally, one further area that we are paying closer attention to at the moment is related party loan arrangements, and particularly those that appear to involve the movement of refundable deposits, or RADs as we said, outside of the approved provider's corporate structure. It's essential that these such arrangements not only comply with commerciality requirements as set out under the Aged Care Act, but also with the requirements of the Corporations Act. The Corporations Act imposes several duties on directors, and these are important considerations in the context of related party arrangements, particularly with respect to directors' duties to act in good faith and for a proper purpose. Directors have an obligation, as many of you would know, to act in the best interests of a company, and entering related party loans or transactions that are not at arm's length and are detrimental to the approved provider may be a breach of their duties to that company. Recently, we've undertaken an interesting project to understand the financial viability risks associated with providers that have complex corporate structures. And we've had a particular focus on related party arrangements, including loans, management fees, rent arrangements, that type of thing, and really checking in on the movement of RAD monies that have been loaned between these related parties. Through this project, we've identified several areas of compliance and financial viability risks, and are now in the process of implementing new processes into our intelligence gathering and analysis functions to support our activities. At times, my section will use formal powers to undertake further investigation and case management of providers that we consider pose an unacceptable prudential risk. And this can be either like an information gathering notice where we might seek further information or evidence, and it can obviously escalate to compliance notices if the need arises. So when we analyse a provider's financial affairs, a key metric we are particularly interested in, which, as you know, is also a prudential obligation, is liquidity. At its simplest, we can say liquidity is the amount of available cash or assets that are easily converted to cash to meet future liabilities. Now, liquidity is important for all businesses to manage, as insufficient liquidity will mean that a business is unlikely to be able to meet their financial obligations if they experience an unexpected reduction in revenue. And this always sounds like it's a really big deal, but I think it's really important to note here, especially for the providers on the line who may have experienced this themselves, this can sometimes come in the form of having had a couple of RADs to pay out, and then instead of them being those beds being filled by another RAD paying consumer, they get paid by a DAP consumer. And so then you've got obviously a little bit of a shortfall potentially. So currently, only residential aged care providers that hold refundable deposits are required to maintain a liquidity management strategy. Those providers only need to hold sufficient additional cash or cash equivalents to repay refundable deposits that they expect to become due in the next 12 months. While that's kind of the lay of the land at the moment, best practice is that all providers, whether they hold RADs or not, work to develop a liquidity management strategy that goes well beyond the current standard. And that's because maintaining sufficient liquidity is essential to being able to navigate short-term cash flow issues without having to cut care, obviously the related expenditure that goes with that, and making sure that consumers aren't harmed, and also making sure they're not risking trading while insolvent. To further support all providers in managing their liquidity, the Commission is currently working with an actuarial firm and considering ways to further strengthen the guidance in any new liquidity standard that is released alongside the new Aged Care Act. This is something the Royal Commission also considered was needed to help build a more financially resilient sector. Hopefully that has set the scene a little bit for the work that we do and how it kind of works in with Rochelle's group. And I'll pass over to Rochelle for her to carry it on. Thank you.
Thanks, Laura. It's great to be with you all today. I recently moved across to the Commission from the Department to establish the Provider Engagement and Monitoring Program. I have a long history of working with financially distressed businesses in both the aged care sector and other parts of the economy before I joined the Department and now the Commission. At the Commission, providers are referred to the program for engagement from a variety of sources. This could be other areas of the Commission, the Department, or potentially providers making direct inquiries. We will undertake a financial risk assessment process to determine if the provider is experiencing financial viability concerns, and we will engage with them as appropriate. Like Peter mentioned at the outset, we recognise that running an aged care business is complex, as there are a lot of things that need to happen around a person who is receiving care, whether that care is being delivered in the home or at a residential aged care service. What I know from experience is that planning and budgeting is made even more difficult without appropriate financial systems and controls being in place. Through my work with providers over the last few years, I know the aged care sector is diverse. It is made up of different organisational structures, and each of them have their associated challenges. They have different operational models, they range in size and location, and they also have varying levels of operational sophistication, including governance structures. Drawing on the insights of Laura's section, we engage with providers to develop a deeper understanding of their unique operating environment, the challenges they are currently facing, and to understand their current and forecasted financial position. We discuss strategies the provider might be implementing to improve their operational position and reduce their long-term risk of failure. Our aim is to work together with providers to build a more robust business practices that will help them operate in a more sustainable manner. As we know, a level of financial resilience is required to enable providers to have the bandwidth to invest in strategies to continuously improve the care they deliver. As Paul mentioned, the Commission's focus is on helping providers we engage with build the capabilities necessary to detect and manage financial risk as independently as possible. So how do we do that? Well, there are a few ways. Firstly, where indicated, we will work directly with a provider displaying early signs of financial distress. We will meet with the provider and talk through our observations, and where necessary, explain how certain financial reporting might be useful in supporting their decision-making, particularly in and around managing their liquidity risk. For example, we may discuss the benefits of improving their cash flow forecasting. Where needed, we may also draw on capabilities outside of the Commission to help us gain a more accurate understanding of a provider's financial viability position. As Laura mentioned, we will at times make a referral to the department regarding a provider's financial viability position if our analysis indicates that they could benefit from departmental program support. These referrals may form part of the department's consideration on whether a provider could be eligible for any of the grant funding opportunities they manage. The decision for departmental program support is determined by the department based on a range of considerations, including the financial situation of the provider, non-financial factors such as strategic importance, and other sector-wide risks. Regardless of whether a provider receives funding support, the Commission will continue to meet and work with the provider until we are satisfied the risks that they are facing have reduced to an acceptable level. It is important we are working with providers to help them manage risks that could lead to quality and safety issues or potential disorderly closures. Our open and regular engagement with providers helps us to mitigate these risks to consumer safety. To give you a picture of what this approach looks like in practice, I'll share an example of where this approach has been helpful in getting a provider back on track. We've worked with a small provider who contacted both the department and the Commission regarding concerns around whether they might be insolvent or not. The provider was particularly concerned they might not be able to afford to pay their upcoming wage cycle to staff. This type of event could lead to continuity of care for residents if staff refuse to come into work due to not having been paid, so it is quite a serious event. A number of the key staff at the organisation had all resigned. The CEO and the CFO had all resigned in the previous 12 months. And the new CEO was really trying to figure out what the provider's financial position was and to try and develop some strategies to improve their financial position. We were able to work collaboratively with the provider on strategies to improve their business processes, including exploring whether the provider was receiving all the funding they were entitled to receive. A review of staffing rosters also enabled the provider to increase their occupancy, which has had a positive impact on their cash flow. The provider was able to improve their financial reporting and governance systems, which enabled them to manage their risk around cash flow management, avoiding an unnecessary risk of closure due to insolvency concerns. The second way we work with providers is through what we call targeted reviews. This is where we look at a specific financial or prudential requirement or risk, sampling a group of providers within a particular market segment. The purpose of these targeted reviews is primarily educational. We review how a provider is interpreting a particular obligation and assist them to address any areas of non-compliance. Through this work, we can gain a better understanding of the different barriers to compliance for specific types of provider groups. This helps us tailor our educational products for those groups while also providing insights about potential risks within different market segments. Over the last 12 months, we've looked specifically at investment management strategies by smaller providers. In September, we will publish an insights report following the finalisation of that targeted review. The targeted review found that while providers have initially established an investment management strategy, they're not reviewing their strategy after its establishment. Where providers engage third parties to manage their investment strategies, they should outline this in their overall governance system. We also recently conducted a targeted review focused on local councils that hold refundable accommodation deposits. The Commission will also release a sector insights report on that targeted review towards the end of this year. We're also very busy developing our forward plan of targeted reviews, and we will promote these activities out to the sector by the end of the calendar year. We also regularly undertake prudential audits. Over the next 12 months, we're looking to complete approximately 100 of these. A prudential audit looks across all obligations and is designed to assist providers to understand the relationship between the different prudential obligations. Our starting point is to use these as an educational opportunity to assist providers that might be struggling with understanding their responsibilities. We work with providers to enable them to rectify any identified issues. Our experience is that most providers are very happy to work with us on rectifying any non-compliance. However, where that is not the case, it may lead to a referral back to Laura's section. They will then case manage the provider until necessary remedial action has been completed. There may also be times where Laura's area might identify and refer a provider to my section for a prudential audit, where a more structured approach to understanding the causes of non-compliance is needed. Previous prudential audits the Commission has completed in recent years have identified that providers tend to struggle with meeting their obligations around the management of RADs. That is what led us to schedule the targeted review into governance systems that is currently underway. We are also starting to develop a similar program in relation to home care providers. We're initially going to be looking at the pricing obligations and practices of home care providers, and we hope to be able to talk more about that soon. Well, I think that is probably enough from me for today, as we're keen to leave some time for questions. Thanks for listening, and I'll now hand you back to Janet.
Wonderful. Thank you, Rochelle, and thank you to the other panel members. That brings us to the end of the presentations, and it's great that we have a fair amount of time now for questions. So please keep them coming in. I'm sure you know how to use the buttons effectively. So shoot your questions in, and there's no such thing as a silly question. This webinar is designed to ensure that we are meeting your information needs as far as possible. We did receive some questions also before the webinar, and I'll draw on those to the extent that we have time to do so. Let me start with a few technical questions, and Laura, I'm going to put you on the spot in the first instance. The first very practical question is Forms Admin still the platform for data entry, and are there any changes made to the previous reporting format?
Thanks, Janet. Well, I think that's a good place to start, because if the data can't come in, we can't do our work. So yes, all financial reporting, so the aged care financial report, the APCS, which is the Prudential Compliance Statement component of the aged care financial report, as well as the 4 quarterly financial report submissions, all of those are lodged through the Forms Administration portal. So the ACFR is due on the 31st of October for most providers, and beyond that, obviously the quarterly reports line up with each quarter and then have a due date 35 or 45 days after that. But as I said, there is the calendar, which is an excellent resource for that one, to keep people in the loop of where they're up to in that reporting cycle. Okay. Usually Forms Admin website, I should just add quickly, will be updated with, you know, the relevant guides depending on what report is about to be lodged. So at the moment we have just taken submissions for quarterly 4. They were due on the 4th of August, and now we're gearing up for the next set, which is actually a bit of a bumper season because we've got quarter 1 of this financial year due on the 4th of November and the annuals that are due on the 31st of October. So we do recognise it's a bit of a pressure point for providers to get all of that in at that same spot. But if they've got any questions, of course, give Forms Administration Help Desk a buzz, or there's the health@formsadministration.com.au.
Laura, is it you? I ask, what if they're running late? What if they're struggling to get in on time? What do they do?
Yeah, so the best thing is always, if you know early, tell us early. There is no legal extension that we can give, but where the Commission can step in is around discretion on whether we enforce non-compliance, or compliance if people have been non-compliant with their obligations. So we cannot actually grant, there's no legal provision to grant an extension, but the more information we have, the better, and that can either go via the forms admin help desk, direct to the Prudential inbox, which I know many providers are familiar with. That's prudential@agedcarequality.gov.au, and also to health. People have lots of contacts at health as well.
So as you say, the more we understand a provider's circumstances and what might be getting in the way of a timely submission of information, the better able we are to engage with them and to reach conclusions about whether there's genuine effort there and what the consequences of a late submission or possibly a non-submission might be.
Yes, that's exactly right. Yeah, and it's also that we can see there's an audit trail behind the scenes. We can see when you've logged in, we can see if people have been actively trying, or if perhaps we haven't seen any activity from a provider at all. That would always kind of, I guess, cause us to query that in the first instance. But definitely any level of engagement that we can get from a provider, and the earlier we can do that, the better. Good
tip. Let me stay with you because there's another very practical question, and it's an extension of the one you just answered. What you mentioned this briefly in your presentation, but I wonder whether you could recap, because I think it is really interesting and important for providers who definitely want to know it. What type of information do we ask for in our engagement and our audits? And I know that's a fairly general question, but if you could just itemise some of the key bits of information that providers could expect to be requested to provide.
Sure. So I think lots of what we do ask for is not to be created. It's off a bookshelf, it's in a file, it's already electronically stored, and it's usually things that providers should have access to and can just forward on. So that might be things, but obviously not limited to, a copy of a provider's liquidity management strategy document, their governance policies and procedure documents. So things that kind of sit behind the scenes that tell their workers or their staffing how to organise a RAD refund, for example. Sometimes it might be decision maps or process flows of information that is unique to each organisation. There may be obviously a RAD register, so where they keep all of the information for the RADs that they've accepted. Sometimes it's even things like bank statements, because we're trying to understand the flow of money. This can be from, I guess, Rochelle's area and our analysis around financial viability. We need to kind of have a sense of what the actual lay of the land is. But sometimes it's also around understanding when did a RAD come in and when does it need to go out, because the dates that are relevant there could affect things like the interest component and that kind of thing. So sometimes it would include really unique documents like that, and sometimes it would be more general documents like policy documents, investment management strategies, that kind of thing.
Okay, well done. Paul, I'm coming to you. You and in fact a few of your colleagues mentioned that the sector was very diverse, and of course we know it, and providers live it every day. And when it comes to financial and prudential risk, there is a live question about whether it's a one-size-fits-all approach by the Commission or how we accommodate that diversity in reaching conclusions about risk. Can you just address that for us?
Yeah, thank you, Janet. It's a really important question that we pose to ourselves regularly as well. Look, we're aware that the sector is not one thing. There's significant diversity. We have small, medium, large, regional, remote, metro, for-profit, not-for-profit, and in amongst that a huge diversity in corporate structures and related entities. We're always seeking to get a better understanding of the sector and through the lens of these segments. And to do that, it's through a range of our activities, including our targeted review program, which really we spoke to a bit earlier, but really allows us to hone in on particular segments and understand the causes and the uniqueness, I guess, of those particular segments, but also through our provider monitoring engagement and the host of data analytics that we undertake. And what we know is that some of the barriers to compliance are not always obvious to us. Those proactive engagement activities help us to understand those underlying causes of non-compliance, and that helps us to better support the sector or particular segments of the aged care market through tailoring educational and support resources to meet their particular needs. And sometimes the risks are caused by a misunderstanding about requirements. A recent example is we have observed a range of small providers holding almost all of their RADs in low-interest bank accounts, which obviously is not maximising potential return because they were uncertain about what they could do to be compliant with the use of RADs. But yes, it is a very diverse market that we operate in, and we really, I guess, are focused on working across those different segments, understanding the needs of the segment and tailoring our both educational and response activities to meet those needs. So definitely not one size fits all.
All right. I'm going to take an excerpt from your answer and pose it to Peter. Peter, we deal often with smaller providers located outside metropolitan areas, moving into regional, rural, remote parts of Australia. Typically, boards which are not drawn exclusively from people in professional careers, perhaps directors who have somewhat less experience in exercising oversight and governance and accountability. I wonder whether you could summarise the fundamentals of financial governance. When we come to look at them, we're looking at financial risk, financial viability, prudential compliance. What are the things we're looking for at the board level?
Yeah. Thanks, Janet. Look, that's an excellent question, and certainly a challenge for a lot of smaller boards. I could give you the very long answer, but I think for the purpose of the webinar, I'll give an abbreviated answer, which is really what I think really assists a board is to avoid divorcing their organisational strategy from their budget planning, which can sometimes happen. So what I mean by that is when you're developing your strategy for the year ahead, you're thinking about that from the perspective of how you're going to fund it as well, because what that does at a board level is starts to help you as a board think about the sorts of financial reporting you would want to pull towards you to track progress over the course of the financial year, but also the sorts of things you would want to know to assess the adequacy of the controls you've got in place to ensure the dollar you allocated for something has gone in the intended direction. And that's particularly important where you are looking to invest in improvements or for that matter, working to build your liquidity reserves in order to support your sort of ongoing resilience to market shocks. So I think fundamentally what that does is it avoids, which can sometimes happen, avoids a governing body becoming a passive participant where financial reporting is pushed to the board and then the board is looking at it out of context, because it ensures that because what it really helps boards to do is then get really interested in those reports, because there's a much clearer relationship between the numbers on the page and what you're trying to achieve organisationally, and particularly also where where some of that investment is to manage risk. What I've found with boards is when they start to do that, it leads them to get much more interested in what other information might assist them in understanding why progress is not being made as quickly as they had expected. So I think it certainly helps in understanding the value of things like cash flow forecasting and also tracking progress against what you expected to receive, so you can start to identify risks early. But to summarise, I think it's really ensuring that you see that your budget for the year ahead is essentially the vehicle you use to deliver on your organisational strategy and using that to equip you as a board to start to pull the financial information towards the board, because it's suddenly answering a question that you have rather than getting an answer to a question you haven't asked yet.
Okay, well done. Paul, there's an extension to that answer, which goes to a more technical standpoint, which is the relationship that we see very clearly between prudential standards on the one hand and quality standards on the other. So it's a different way of coming at the same question, but this is from a technical standpoint. Do you just want to address that briefly?
Yeah, certainly. Thanks, Janet. Look, there's a direct correlation between the two sets of standards under which aged care providers are obliged to meet. Both sets of standards actually are designed to establish obligations for providers to manage risk, which may ultimately impact the quality of care. Now, the prudential standards set out the obligations of providers in relation to disclosure, governance, records, and liquidity. And these prudential standards are focused on ensuring appropriate governance oversight and financial management controls enabled by appropriate records management and transparent through disclosure obligations. Now, both sets of standards, quality and prudential, have governance obligations. The governance standard in the prudential standards relates to the controls and management of RADs, while the governance standard in quality standard, number 8 in particular, contains a financial management requirement and is designed to ensure providers have other suitable controls in place to support quality and safety of care. Now, that standard applies to all providers of aged care, not just those holding RADs. So both standards describe activities that all providers should be doing to ensure they are in control of their organisation and that they promote accountability, transparency and responsibility, which is a good thing to have for everyone. Thanks, Janet.
Thank you. All right, Rochelle, you don't escape notice. I've got a technical question for you, or at least a pragmatic question. We've received a question around how you identify the providers to be targeted in the 100 audits that you described. So is there a particular frame of reference that you use in order to identify the ones that you look at most closely?
Thanks for that question, Janet. We use a risk-based approach to prioritise which providers we select for the 100 prudential audits. In assessing that risk, we look at a whole range of information which is available to us, and only a small portion of that is financial data. So this year, we're going to be undertaking up to 100 audits, which is a lot greater number than we've done in previous years. And we are going to be focusing on providers that are located in regional and rural and remote areas. The purpose of the audits will be to ensure that these providers have a good understanding of their prudential and financial obligations, and that those providers are able to continue providing care in those relatively thin markets. So this aligns with the intent of the Aged Care Act in the accessibility of care for consumers.
Okay. And a number of you have mentioned that our keenest interest is to see providers thrive. So we will be doing our best if we find people falling short of their obligations. Our first response is to engage, to understand where the provider's at, to understand where they may have misapprehensions or have lost sight of some of the objectives, and to nudge them gently towards that remedial action. And that will be our first opportunity of ensuring that they understand we're serious, but that we're not going to reach for the heavy-duty regulatory tools prematurely. We'll give them every chance of staying out ahead of us and addressing where there may be non-compliance or, more seriously, risk of harm to consumers. I think we have time for one more question. And Rochelle, I'll stay with you. Where we find a provider who's struggling financially, and they do come across our radar. What are the options? We don't have a fund, we don't have a kitty which enables us to make any grants available to providers, but there are options. Can you just set those out briefly?
Yeah, that's another really great question. Although we don't have access to any grant funding, I did mention that we do have the ability to refer providers over to the department that does have grant funding available to it to support providers based on their eligibility. But we do have other sort of, I guess, mechanisms in which we can assist and help providers. And a lot of it is around the planning work that Peter was mentioning, the strategies, making sure boards are informed of the financial circumstances of a provider, and really helping the provider zero in and look at the particular performance of different areas of their business. So by working with them to develop that shared understanding of their financial position and the risk factors that they're facing, this often leads to the provider being able to implement some actions that can help improve their financial situation in the long term. There is information available on our website and also the department's website. And if anyone ever wants to reach out to our team, they can contact us at peams@agedcarequality.gov.au.
Okay, well done. Last question. We've had a number of questions come in on the liquidity standard, and some of them are very technical, which probably don't lend themselves to an answer on a webinar. But Peter, perhaps I can close with you, or possibly one of your colleagues. There's a really pragmatic question about whether liquidity is intended to cover the RAD forecasted for refund in the short term. Now, the detail of calculation of liquidity is obviously on our website, and I know that we're doing some work on that, which we are hoping to share more widely with providers in coming months. Is there anything you can say briefly on that?
Yeah, look, and I'm glad that question came up, Janet. So under the current liquidity standard, a provider needs to make a decision about what they think they will need to pay out in relation to RADs in the year ahead, based on their past experience and other risks that they foresee. So at the moment, that means there's very little guidance for providers. They really just have to, it's best efforts for them based on their understanding of their residents and likely RAD outflows. So in answer to the question, when a provider does that, they're looking at the year ahead and what they expect that would look like in the year ahead. But that's where we're really keen to give providers a lot more guidance around how to calculate that in a much more accurate way. So and that's what we referred to. I think it was Laura referred to earlier on, is that we've had an actuarial firm in to give us some assistance around what a way of calculating it might be at the provider level, to assist providers to start to make more informed decisions about the liquidity holdings for the year ahead, rather than just speculating on previous activity.
Wonderful. All right, that's as much time as we have questions. How much questions we have time for, and the balance of them will be addressed through our website. So please keep an eye on the website. Keep in touch with our publications on financial and prudential regulation. You can subscribe to Financial Prudential Regulatory Insights. All of this is available through our website. Please stay online at the conclusion of the webinar to complete the survey. As I said at the outset, we are very pleased to get your feedback, and we do pay close attention to it. My thanks to Peter, Paul, Rochelle and Laura for doing such a champion job in conveying what is fairly complex information, and I think it has been a very straightforward manner. Thank you all for your participation today. We look forward to seeing you in subsequent webinars. Thank you very much. Bye-bye.